Now, a very good afternoon, a very good morning. Welcome to HYCM's workshop with myself, Giles Coghlan, consulting on behalf of HYCM. Do hope everybody's well, that you can see my screen and hear my voice okay. Very good to see some good faces here. Gavrel, glad you could make it. Kingsley, glad to see you. Thomas, Todd, good to see you. Mihai, good to have you back. Eddie, welcome. Farhad, very good. Now, for those folks who are just coming in, if this is your first time here, don't forget, as we look at different entries, exits, different instruments, different trading scenarios, all of this is done from a educational perspective. The idea is you look at over my shoulder as a professional analyst and you see how I'm making my own trading decisions. On my own trading account, you can see how I go about making currency decisions and various other assets. The whole idea of this is not a signal trading service, it's just you looking over my shoulder and educational. Now, we're going to be looking at, my screen has frozen. There we go, excellent. Now, what we will be looking at today is a couple of things. First of all, we're going to look at the US core PCE data for Friday. I'll be looking at that by the end of the session. I also want us to look at the New Zealand dollar. There's been some significant moves in the New Zealand dollar today, and I'm showing you an opportunity that I'm looking at over the next sort of 24, 36 hours, how I'm going to play it. I'm going to outline that to you now as well. And also, I'm just going to outline a technical learning tip for gold, starting to see gold trying to bottom. I'm just going to show you, what that actually looks like. If you can let me know you can see my screen and hear my voice, okay, that would be great. Mihai, you beat me to it. Thank you very much. Always appreciated, and a reassurance to know that I'm coming through loud and clear. Thanks, Gabriel. Excellent, excellent. Right. Look, we've got quite a lot to cover, and there's some really great learning points. So without further ado, let's just get stuck in. Okay, so just going to exit out of the webinar, and we're going to go into my other screens over here. Now. If you take a look at the New Zealand dollar today, you will see, in terms of currencies, do you see how the New Zealand dollar has just plummeted? That's the purple line here. The rest of the currencies are comparatively holding up. The New Zealand dollar is just sinking very, very strongly. Now, that, of course, is because the Reserve Bank of New Zealand met last night, and I'll show you how this works. Now, the Reserve Bank of New Zealand was expected to hike interest rates by 25 basis points, right? And in fact, there was even expectations that perhaps they could have gone as high as 5.75%. And what the Reserve Bank of New Zealand did is they surprised markets. Yes, they hiked by 25 basis points, but that was completely expected. But the surprise was they indicated that they feel is the final end to their interest rate hiking cycle. They sort of said that, yes, interest rates are expected to remain restrictive. And if you just take a look here, you can see they're at 5.5%, and they're expecting them to stay at 5.5%. But immediately out of the meeting, do you see how short-term interest rate markets have just dropped expectations now? And now for the July meeting, short-term interest rate markets are seeing a 75% chance of no interest rate hike. And the Reserve Bank of New Zealand themselves have indicated that they're going to try and keep this peak forecast at 5.5%. In other words, they're not anticipating any further interest rate moves. Now, prior to this event, short-term interest rate markets, you can see here, we're expecting at least another interest rate hike, up to 5.70, so probably around 5.75%. So they were expecting another interest rate hike. The Reserve Bank of New Zealand has said no. So we had the expectation going into the data interest rate decision, and now the data has surprised. So that's why the New Zealand dollar suddenly lost value, right? It suddenly lost value. Now, the go-to currency pair for trading, the Reserve Bank of New Zealand interest rate decision, is the Aussie New Zealand dollar pair. Both of them are high beta currencies. Both of them tend to move when it's risk on and risk off. And if you're trading a divergence between the Reserve Bank of Australia and the Reserve Bank of New Zealand, the Aussie-New Zealand dollar pair is my go-to pair. So I'm looking to go long on this pair. Why? Look at the bond yield spread. Now, what the bond yield spread does, that's the purple line, it shows you the interest rate expectations in bond traders and what they're expecting between the RBA and the RBNZ. The Australian 10-year bond minus the New Zealand 10-year bond is called the bond yield spread. And it shows you the difference that rate traders are expecting. Do you see how price tracks the bond yield spread so closely? And look here, look on the daily chart. What do we see? We see the Aussie-New Zealand dollar trying to break out of this potential trend line to the downside, right? And if we look at the momentum, we see momentum has firmly moved to the upside. So traders are now expecting the Aussie-New Zealand dollar to move higher. Will it reach 1.0850? Will it reach 1.0900? I don't know. But as long as that bond yield spread remains pointed to the upside, then I would anticipate buyers. So how do you deal with this? Well, for me, I'm expecting Aussie-New Zealand dollar strength for the next 36, 48 hours for sure into the end of the week. So that means any pullbacks to 1.0650, I would consider suitable for buying. I put a fib retracement level just up here, and you can see here in the fib retracement level at the 50% and the big round number 1.0650. So any moves down to 1.0650, I expect buyers. Now, it may be that this becomes more aggressive if you don't get the pullback. So another option is to look at sort of a flag or a pennant pattern. So a flag or a pennant pattern is when you start to see, price moving up and then it pulls back slightly, and you can sort of draw a small channel. That would be like a flagpole, and if the pennant sort of the flag moves back to the downside, right? Then you could look for a break to the upside. For now, over the next 36 hours, if the Aussie-New Zealand dollar pair falls into this region, I would anticipate it retesting 1.0700. So reasonably, bounce here to there is a reasonable expectation. I would expect a profitable trade in that instance. Now, of course, it could go wrong if the RBNZ changed their outlook, if there was something that changed the bond yield spread between the Australian 10-year bond yield. Of course, if there was some specific news for Australia, which is very, very negative, of course, we could see the Aussie falling and the New Zealand dollar gaining in value. So, no outlooks are foolproof. All outlooks have risks. This is no exception. But this is how I'm trading it, okay? And that's the rationale, that's the logic, that's the entry. And my stops, I would place just underneath that 1.05600. But the driver, you see, is the interest rate change. RBNZ are not expected to be so aggressive. And you can see here, they said the decision was seen as dovish as a central bank maintained its peak rate forecast of 5.5%, which is the current level to suggest that its hiking cycle is done. The RBNZ are saying, mission accomplished. We've achieved our goal. We've done what we came to do, and we're satisfied with the level that we're at. Okay, so that is what the RBNZ have done. Okay, so that is that. Okay, now, had UK inflation data out today. That was a short-term trading opportunity. Just notice the CPI and the PPI diverged. So the CPI came in quite hot, very hot, in fact. The core 6.8%, and headline 8.7%, and the month-on-month 1.2, and the month-on-month the core 1.3. So very hot, but the PPI was a bit lower. So a bit of a mixed print, and we saw a bit of choppy price action in the pound. I won't get into that now. I want to show you one last thing with the New Zealand core. Do you see how inflation is quite heavy for the New Zealand? Do you see a 7.3% is quite strong for the core? So watch inflation data going forward. If inflation, say this core rises to sort of 7.6% and starts moving higher again, then expectations will increase that the RBNZ needs to be more aggressive and hike interest rates. So you can see the New Zealand dollar start to gain in value again. So look at inflation data very carefully for the outlook between the RBA and the RBNZ. Great, that should all be very clear. Now I want to show you, as promised, something technical in gold. Gold is making some really interesting technical moves right now. I've been watching this over the last few days. Now, if you look at gold, this is gold on the daily chart. Now, if you look at this if you zoom out, you'll see there's a couple of support levels in gold. That first one I've got marked around the 1880, 1900 zone. That's obvious. I've also got another support level coming in just at these highs here around the 1960 region. Okay, just above the 100 exponential moving average. You can see here, old resistance is broken, becomes new support, support, moves back down support. Gold prices are trying to bottom. Now look at this. This is a daily chart, by the way. Now look at this close up. What do you see? You see consolidating price action. This is a harami inside bar. Harami literally means pregnant in Japanese. So it's the mother candle is within the body. The mother candle here is within the body. The baby candle is within the body of the mother candle. That's what harami is. So you see that body is actually within the body of the prior candle. And then we have another harami inside bar because that body is within the body of that candle. So it's not an inside bar, this is a harami inside bar, which is different, which is the body is within the body of the previous candle. And what this shows you is consolidating price action. It often happens when markets are preparing to break out, they coil. Then yesterday we had a Hikaki pattern, and this is the false break of the inside bar. Now it's a minor Hikaki pattern, it's not a complete break of the inside bar, it's a false break to the downside, and now price is trying to move higher to the upside. We've moved up to this overhead resistance and price is just consolidating. But if you look at this on an intraday chart, you'll see what's happening very, very clearly. We're getting consolidating, coiling price action. This is wanting to break out. Now, I'll tell you the clues to whether this is breaking out. If this, on the daily candle, if the daily candle closes above the 23rd of May high, technically, it will want to bounce back off here and move higher, for looking to test that 2000 region. Okay, and that is that longer term trend line coming in across here. So price is wanting to move from here to there, break and close above that, and then it would look to move higher. We've got debt ceiling talks, we've got dollar gains, yields gaining. All of that is creating a very choppy fundamental picture. But I just want to look at this technically for us so you can see what's going on. If that breaks and closes above this level, then any retest back down to 1980, you'd expect to find buyers technically. Okay, so very interesting patterning going on there, and you can see that gold's trying to bottom. For those of you who want to know what's driving gold, gold is being driven by the movement of real yields and the dollar. So when you see real yields moving higher, the blue line, the dollar moving higher, the purple line, gold's push lower. Okay, when you see real yields and the dollar moving lower, gold moves higher. You see here, look, real yields, the dollar moving higher and higher and higher, gold moving lower and lower and lower. So we have been recently having real yields and the dollar moving lower. Okay, that pushed gold up. Now the dollar and real yields pushing higher on economic concerns, debt ceiling worries, bids into US 10-year treasuries being sold off, people not wanting to hold US debt because of the debt ceiling talks, yada yada yada. All of that is a natural headwind for gold. But if we start to see real yields falling and the dollar falling again, gold can just rocket higher and potentially make all-time highs. So keep your eye on real yields and the dollar. Wow, I told you we've got a lot to cover. We're getting through it. Now, the next point is US core PCE. Now, that is crucial. And that, if it wasn't for the debt ceiling talk, I'd be very excited about this data point. But the first point we have to make is the US core PCE. Now that's the Fed's preferred measure of inflation, and it has been since about 2012. We all know the Federal Reserve has been very clear in saying that they are committed to bringing down US inflation. They've got that 2% target. Inflation in the US is still exceptionally high. And if we just take a look here at the US, have a look at the headline inflation. It's been moving lower steadily, but it's still at 4.9%. The core inflation still at 5.5%, core stickier like many countries around the world. If we just compare the G20, see that US is pretty much in the middle of the pack, 5.5%. New Zealand, you know, was at that 7.6%, so very high. Euro area 5.8%, UK very high at 6.8%. So inflation in the UK very bad. US managing to do, you know, middling, and the inflation print on Friday will be key. This is the Fed's preferred measure of inflation. Now, the way you trade these is you look at the minimum and maximum expectations, looking at the red. Now, the year on year is expected to fall to 4.1 from 4.2. That's a dollar negative pressure. The year on year headline is expected to stay at 4.6% versus 4.6 prior, month on month 0.3, and the month on month normal index 0.2. Now, this is what I would want to see dollar weakness. And this, the instrument I would personally trade would be the dollar. You can either trade euro US dollar or gold. So in the instance where this comes in below 4.1 and the year on year comes in below 4, so that's 4.1 for the year on year, below minimum expectations, 0.1% or lower for the month on month, and below 4% for the headline, and 0.2% or lower for there. If that was the case, I would expect yields to fall, the dollar to fall, and gold to gain. So that for me would be a short-term opportunity to trade gold. The upside target would be that 2,000. If we get up to 2,000 by Friday, then I'll be looking at breaking back up into that range and back to that 2015, 2020 region. And if that's gone, then I'm looking up at those, you know, towards those 2040, 2050 regions. So at the moment, that's a great structure. Now, the reverse is also true as well. Say this came in very, very high. Say the year on year came in at 4.8%, and the year on year for the headline came in at 4.3%. This was 0.4%. This was 0.3%. Say that was the case, and it's all red across the board above market's maximum expectations. I expect that to be dollar positive. I'd expect yields to rise. Why? Because investors will think the Fed needs to do more. Inflation's worse than people were expecting. The Fed has to keep hiking interest rates, more interest rates, stronger yields, stronger dollar. So I'd expect the dollar to gain, and in that instance, I would expect euro US dollar selling. Okay, so a big miss, I'd expect gold upside. A big beat, in other words, the data very strong, I'd expect in the case of a very strong data print, dollar strength, so euro US dollar selling, or potentially pound US dollar selling. It depends. I think I stick with euro US dollar selling. I think it'll be more straightforward, particularly because we don't know what's going to be happening between now and Friday, right? So that at this stage of the week, this is what I'll be looking at. Now, I said it was tricky, and the tricky bit is we've got these US debt ceiling talks going on, and the debt ceiling talks means that the US equity markets are focusing very much on that rhetoric, what's going on with debt ceiling talks. There's a genuine worry about a default risk growing for the US. Mainly this debt ceiling talk is all political posturing. And for those of you who don't know what the debt ceiling talk, it's all about the maximum amount of debt that the US government can have. It's set at $3 trillion, and they want to increase that ceiling to allow for more spending, to allow for the promises and the services they're expecting to provide for the United States people. Now, they should increase the ceiling, but they have to vote on it, they have to agree to it. And it's becoming political, a punching bag scenario where the Democrats and the Republicans want to sort of blame each other. They want to try to negotiate different deals, and they want to push it as close as they can to the line. It's called, you know, brinksmanship. How nervous can they make each other? That game of sort of chicken, who's going to flinch first, who's going to cave in? And it's not a very, you know, good political situation, but it is mainly political. So that's why we've been seeing 10-year yields gaining, right? So do you see how the 10-year yields, they keep gaining and gaining and gaining? People have been selling bonds, selling bonds, selling bonds. Why? Because people are not wanting to hold US debt. Well, what happens if the US defaults? You know, that'd be disaster, right? Yes, Gav Rails puts it very much a big drama show. You've got it. So that's the scenario. But we have to be careful, because sometimes, you know, you can create a show and it can go, you know, it can go off in your face. So there is a potential risk still here. And that makes it very difficult trading this PCE print, because it's not going to market's focus. The market's focus is still the debt ceiling talk. So the way I will deal with that is that my trading would be very short term. So what I expect is a short-term reaction if we got a miss or a beat, as I outlined earlier, and then I would take profit quickly personally, because I don't want to be having open risk, you know, for a very short-term trade, at least, with those debt ceiling talks going on. Okay, so I hope that that's clear, but that's what I'm looking at for Friday. Now, don't forget, this Monday, I look at all the big events that are coming up, and I start to focus us in on what the key data points are, what the key events, economic calendar points I'm looking at. And on the Wednesday today, I outline, you know, how to go about how I'm personally looking at trading them. Remember, this is not trading advice, and because I have to, you know, leave this webinar, it's market conditions change, so you have to always have to do your own research, and obviously we're all trading our own capital, you have to make your own decisions. But I hope by looking over my shoulder, you're seeing how I'm going about making my own trading decisions and how I'm dealing with, like, you know, significant risks. And but these are the expectations that I'm expecting. One thing I would say with this piece, this inflation print, don't forget that consumer expectations, the final ones, are coming out later. Now, these are the final data point out, and you might miss this and think, oh, this isn't important. Some economists love this Michigan consumer expectations print because they see it as a more accurate portrayal of how the US consumer is doing. You know, businesses, they can, you know, make plans over 1 year, 2 years. They can, you know, maybe run a couple of years, you know, not so profitable, and they can make, you know, they can squeeze through difficulties. The consumers tend to be very, very responsive to a drop in income. So sentiment from US consumers is really looked at here, and also those inflation expectations. Now, they rose significantly last time, 3.2% up from 3%. That's a big deal, because that's the US consumer saying we think inflation is here to stay, right? We want to see that drop. But also remember, we still have got that debt ceiling drama. So remember, this could be a big miss, because these US consumers are being asked about the state of the US economy in the middle of these debt ceiling talks going on. And your average Joe in the US is not going to necessarily understand, you know, the finer points of what's going on in an economic world as people who are trading and investing are. Okay, so it means they're much more, you know, susceptible to the drama of it, is what I'm trying to say. So don't be surprised if this is revised lower, and don't be surprised if the inflation comes in hot. But remember, that could offset what's happened earlier at 130. So be very careful about holding a position from here, because we've got the debt ceiling talks, then we've got that Mexican consumer data coming later. So for me, short-term opportunity, you know, 5-10 minute move to the upside or the downside, in, out, as long as I get a miss or a beat. That's how I'm personally looking at trading it. They're the instruments I'm expecting. Of course, the market can always surprise you, so I always manage risk in case there's a surprise element. Folks, very good. We certainly covered a lot there today. Yeah, Gavra, that's it. Scalp it. That's what I'll be looking for. Thank you all very much. It's been an absolute pleasure. God willing, I will be back here on Monday, 12:31 p.m. GMT time, and that's 1:30 UK time. Thank you all very much. Do take care. Have a very good rest of your session, and thank you for attending. Goodbye and take care.